So there's two different types of life insurance. There's term, and then there's permanent.
Ouch.
That's a great example of you needing life insurance, right? Term is kind of like renting. Permanent is, of course, very similar to buying. So let's talk about the two different types of life insurance. So with term insurance, there's three different types of term insurance, as if it didn't get any more confusing, right? There's something called annual renewable term, where every single year your premium may change. Then there's another type called level term. In level term, you can get a 5-year, 10-year, 15-year, 20-year, 30-year, 35-year, and nowadays even a 40-year level term. What that pretty much means is that the premium is level every single month. You can guarantee that it's going to be the same amount every single month to cover the death benefit. Now, that's the second type of term insurance. The last type of term insurance is called return of premium term insurance. This is where you get all your money back at the end of that specific term period. So let me give you an example. In annual renewable term, let's say I have a $500,000 life insurance policy. It may cost me $50 a month in the first year. In the second year, it may go up to $53 a month. The third year, it may go up to $56 a month. It's annual renewable term. In the secondary type of level term, it could cost me about $67 a month. But every single month, it's guaranteed $67 for the next X amount of years. In the last type of term insurance, return of premium term, for example purposes, it may cost me double what the non-return of premium level term will cost. So in that scenario, it would be about $150 a month. You take $150 multiplied by 12 is $1,800 a year. $1,800 a year multiplied by 30 equals $54,000. Sheesh, this is getting confusing, right? So those are the three different types of term insurance, otherwise known as renting your insurance. The secondary type of life insurance is called permanent life insurance. Now there's 4 different types of permanent life insurance. There's going to be whole life, there's universal life, there's indexed universal life, and then variable universal life insurance. So in each of these insurance chassis, as I call it, they're built on something that I give an illustration of an egg. So in this egg illustration, as you can see, the egg yolk is normally smaller than the egg white. But sometimes that egg yolk is a little bit bigger inside than another egg. The same thing applies in life insurance. There's no such thing as a bad insurance company. There's just bad agents that design the egg yolk and the egg white completely different. The egg yolk in this illustration is going to be cost of insurance. In the egg white, it's going to be the investment. So if I get a universal life insurance policy and I'm investing into my universal life insurance policy, $300 a month, a portion of my $300 is going towards cost, and a portion of my $300 is going towards investment. Now, what separates all 4 of these life insurance policies is this: the rate of return and the strategy inside of that permanent life insurance. The permanent life insurance policy in a whole life may yield a 5%, 5.25% rate, or even a 5.5% rate. That's excluding dividends, where dividends is now you're giving back money. The insurance company is giving back money to their investors inside of the life insurance. So if I'm an investor, let's just say I'm with XYZ Life Insurance Company, and I put in X amount of dollars, and I'm getting a 5.25% rate, and they give me a 1% dividend, now I could be yielding a 6.25% rate on my egg white. Here's the big question though. What is my cost of insurance? If you get an agent out there that goes, well, I don't know, or that's not really that important, run. You want to know all disclosures possible, and I'll get to that at the end of this video. So in whole life, you're getting a fixed return. In universal life, you're normally getting a little bit smaller fixed return. In indexed universal life insurance, it's linked to an index. So lots of indexes out there. There's the S&P 500. There's the Dow Jones Industrial Average. There's the Hang Seng, which recently people don't want to be a part of the Hang Seng, of course. So there's a bunch of different indexes inside of this permanent life insurance chassis. So dependent on what the index does inside of your life insurance policy is going to be dependent on the returns that you're getting inside of that policy. Here's the terrific thing about indexed life insurance. Zero is your hero. Meaning if the index goes down, you get zero and sometimes even get a guaranteed 1% rate of return. In the index though, there's a cap rate. So some insurance companies have a 9% cap rate. Some insurance companies have a 12% cap rate. Some insurance companies have a 17% cap rate. And some insurance companies have no cap rate. So all of these indexed universal life insurance policies, it's a moving target. You need to know the questions to ask before you jump into one of these particular plans. In variable universal life insurance, it's completely based on the market. There's sub-accounts inside of these variable life insurance policies, and it's dependent on the stock portfolio that the advisor chooses inside of the variable account. In variable universal life insurance, you can lose money. So if you're putting $300 a month into your policy and $100 is coming out for cost of insurance, $200 is going towards that variable investment, and if you lose money, you could be losing a portion of the $200. So, in summation, several different types of permanent insurance. We know that. So term insurance, some of the questions to ask is, number one question to ask is, how highly rated is this insurance company? You don't want to be putting money into the insurance company and then it's a B-rated insurance company or C-rated insurance company and they're not solvent enough to guarantee your life insurance. Question number two may be, what is the term period and what type of term insurance is this? Is this annual renewable term? Is this level term? Is this return of premium term? What type of insurance are you illustrating to me? And then in the permanent chassis, several different questions to ask about permanent life insurance. Number one question again is, how solvent is this company? How highly rated is this company? Are they A with Standard & Poor's? Are they AA with Moody's? What's the rating status on this life insurance company? The other question, the next question is, what type of life insurance are you showing me? Is this a whole life? Is this a traditional universal life insurance policy? Is this an indexed life insurance policy? Is this variable life insurance? And then from that, you can ask another question, which is, what are the internal fees inside of this policy? So if I'm putting $300 a month into the policy, how much of the $300 is going towards fees and how much of the $300 is going towards my investment? Several different things that you can use the term and permanent insurance chassis for. I've seen business owners that insure their business partners. So if you got business owner A and business owner B and they both own a business together, and business owner A says, hey, Business owner B, if he dies, unfortunately, is his spouse going to come in and own my portion of the business? So they create something called a buy-sell agreement, which you can listen to in one of my other YouTube videos. Or a key man life insurance policy. In that same scenario, business owner A and B, they both own the business and they have one of their very important employees where if this particular person weren't to be with the company anymore, that would cause them to have a negative return inside of their business. So this particular employee, whether it be a president or vice president of the company or manager of XYZ company, they're a key man inside of their company. So they insure that key man just in case something were to happen to them. Another purpose to life insurance is obviously income protection for the family. So if a guy is the primary breadwinner to the family, you want to make sure that they're insured just in case something were to happen to them. Another purpose to these permanent life insurance policies is something called tax-free retirement strategies. Again, this is getting crazy. So other reasons for these permanent insurance chassis: college supplements. So people will put money inside of these plans, and then little Johnny goes to college 17 years later or 13 years later, and they snag some money from the insurance policy so that they can pay for little Johnny's college. Another use to these insurance policies are, like I said, tax-free retirement strategies. So you can grab the money, pull it out, and use it as a supplemental retirement plan for you and your spouse potentially in the future. Another reason to use these permanent insurance chassis is they may want to flip properties. So you'll see some flippers, some investors that grab X amount of dollars from their life insurance policy, buy a piece of property, flip it, make a profit on it, and then grab the money and put it back into their life insurance policy. So flipping is a big option. And then, of course, the biggest one, which is unfortunately something happening to them. So if a business owner or an employee were to have a heart attack, stroke, cancer, God forbid, go blind, have an amputation, ALS, things that happen on a day-to-day basis, you can grab a portion of the death benefit and not have to die to use it. That's in both term and permanent, ladies and gentlemen. I know there's a lot of questions that are on the tip of your mind. You're thinking, man, how does this apply to my current situation? How could it apply in my situation in the future? Some people ask me, they go, Manny, when's the best time to get life insurance? And I normally ask them, are you planning on having a family in the future? Are you planning on owning a home in the future? Are you planning on passing away in the future? And they, of course, laugh and they go, of course. I say, well, you're not getting any younger. So the best time to buy life insurance is always going to be at your youngest age and when you're most healthy. I know you have a lot of questions. I know you have a lot of options. Choose wisely. Choose a TFA agent or broker in your nearest neighborhood or Zoom. And I'm sure they're going to give you a quote that is going to reflect exactly what you and your family need the most. We value your business and we look forward to our next conversation with you.